Hi, everyone. I'm Catherine Anaya, and welcome to the Women's Eye podcast. This is where you'll meet fascinating women who are leaving their mark, making a difference, and changing lives. This episode is brought to you by Casco Financial Group, located in Phoenix, Arizona. Catherine Scrivano is the president of Casco Financial Group, and she started her business to help people create the financial strength they need to achieve their dreams. And she believes you don't have to be wealthy to be wise. Catherine Scrivano is my guest today to talk about financial biases, decisions based on inaccurate or irrational conclusions that can sometimes lead to choices that don't serve us. So let's say hello to Catherine. Always good to see you.
Hi, it's very nice seeing you as well.
Well, thank you. So this is an area that I hadn't really thought of before we decided to talk about this particularly for this episode. What exactly is financial bias?
There's a field of study called behavioral finance, and this is an acknowledgement that we humans often do things for reasons that are not necessarily rational. And bias is a word that people are recognizing right now a lot in conjunction with national and political news. And it gives us an opportunity to talk about something that we've acknowledged in the financial world for a long time, which is financial biases. These are things like other biases where they're based on things that may not be rational. But we seem to be hardwired. It's just being human.
Well, when you say rational, why is it good practice to ask ourselves why or the rationality of some of these conclusions that we come to?
Well, speaking only in the financial decisions, being rational gives us a better chance to screen what's appropriate and what's not appropriate. One of the exercises that we recommend as people are considering alternatives, if they arrive at a conclusion, not just limiting themselves to the numbers, but the why. Why did we come to that conclusion? If we're going to improve financial decision making, we need to give ourselves permission to think about our motivations and see if we find sometimes it just doesn't line up with what we really believe.
Absolutely. And that's a perfect reason why we need to find out what the basis is of the conclusions that we come to or the decisions
Mhm.
that we come to, especially when we talk about money. So let's go through some examples. The first is what you call recency bias, which has to do with putting emphasis on recent events. Can you
Right,
explain
right.
that and why that's not a good practice?
Well, we just need to acknowledge it. We need to know that if we're putting a lot of emphasis on recent events and not as much weight on things that have happened in the past, what we're automatically doing is skewing ourselves for short-term thinking. And during a bull market, when stocks are going up, people become very tolerant of risk because they don't really think about the potential for things going down. And the same is true in the depths of a bear market. Investors will flee stocks and think the whole future looks hopeless. And it's really due to just latest pricing. So when we're talking about recency bias, we always ask people to be aware of the words momentum and trend. Those
Hmm.
things can suggest that we're really talking about short-term information. And just make sure that you have consistency about a disciplined long-term investment horizon with very specific goals. And then you can screen out things that might just be recent noise.
Mhm. You also talk about overconfidence bias, which sounds pretty obvious. How does it impact, though, financial decisions?
You know what? We can forget that we're vulnerable. We tend to think that we're bulletproof based on things that have gone right, and think that we have more control than we actually do. It implies that we just overestimate our knowledge, underestimate risk, and again, that exaggeration of our ability to control events. So, you need to think big outside of your the tip of your nose. One example that I thought of is, you might be the very best taxi cab driver, but if people are starting to use rideshare services, you may not be able to pay the bills. So having an awareness of what's going on around you and outside of your own sphere of influence.
That's a great example, just knowing what else is out there, what the competition
Mhm.
looks like. Another bias you refer to is what you call self-serving bias. And when I think financially, I'm thinking, well, of course I'm supposed to be serving myself. It's my pocketbook. So what exactly does that mean?
And I'm not going to discourage you from that for even a second, but I want you to be sure that when you have successes, that you don't over attribute them to your own skills.
Mm.
And any failures just become bad luck. We have to have a reality check. In the case of stock markets, sometimes if new information is in line with what you expect, you increase your confidence. But if you get information that conflicts with your expectation, you may not give it the weight that it deserves. So knowing your own perspective and being sure that you're listening to new information with an open mind is very important.
Yes, absolutely. Be realistic. You also talk about herd mentality. It's another bias that tends to rely on emotion, right?
Mm-hmm. Yeah, this is what causes surges and plunges because it makes us act on emotion rather than reason. If we all know a time to buy is when a stock is out of favor and the price is down, rather than when it's so popular and lots of dollars are chasing it and increasing the price. But it's very hard to act against what everyone else is doing. So watching what others are doing isn't good information. It's very informative, but we need to stop for a minute and be willing to evaluate any action, making sure it's based on our goals and what's appropriate for us.
Hmm. And that's also a good reason why we need to be educated, especially
Sure,
on those financial terms that we've, talked about in the past before and the importance of that.
I couldn't agree more.
You also point to something called confirmation bias. Would you describe that for me and what that can lead to?
And boy, are we susceptible to that now. When I hear confirmation bias, I immediately think of social media. This is an inclination to ignore or undervalue any information that goes against our views.
Mm.
And instead, we're looking for information which will definitely be available that confirms our belief. So instead of accumulating facts and checking for relevancy, we start with a conclusion and then search for information to verify it. We kind of end up like a dog that's chasing its tail. We're not going anywhere. We're very, very active and we've got a lot of busy work, but we're really not accomplishing or making progress.
Well,
What
and
there's
that
a
requires time, right?
Sure it does. And here's a
Hmm.
suggestion that you spend some time, and again, social media will make this very available to you. Find somebody who disagrees with you.
Mm.
And your assignment is not to persuade them to see your point of view, but to understand why they disagree with you. So if you have a particular investment philosophy or something that you're really considering implementing, and you can find someone who says that's not a good idea, if you can undertake the task of understanding why they think that, you're not trying to persuade them to see your point of view, and you're not necessarily trying to change your own mind, but if you can arrive at the place where you understand their point of view, you can honestly say the next move is the most appropriate for you. And it just kind of gets you out of the rut. It's very,
Hmm.
very simple to fall into just the rut of confirmation of what I think over and over and over again. It's good to shake it up a bit.
Well, that sounds like great advice for behavior purposes outside of finances, just in
It's
general
really
in
hard.
life.
Yeah, it's hard to just limit this to numbers, but we can think about the application. This has been studied for a long, long time, way before social media. Behavioral finance was a field of study, and some of these techniques have been true for ages.
It's so intriguing. The last bias you talk about is anchoring bias, putting too much weight on an initial piece of information. Can you give me an example of that and why that's not good practice?
If you have that anchor and you get stuck there going forward, you're not looking at things that are relevant. It's very, very simple for us to talk in investment terms right now. If we think what was going on in stocks, think of restaurant stocks a year ago. As the pandemic was really starting to move forward, businesses were closing down, restaurants were closing down. And if you looked at the price of a stock in any of those fields and said, this is what the value is. Here you are a year and a half later, it's well exceeded that value. And there are reasons for that. There are management decisions and market decisions and a lot of things that have influenced that price. But if you've stuck in your mind that that's all the value is, you would be missing opportunity. We don't have, fortunately, the experiences of the pandemic very often, but I'll tell you where we often see the anchoring bias is when people inherit a stock or a portfolio. And just because it was an appropriate portfolio for the person who passed it on, we need to not just love that thing, love those stocks just because mom and dad loved them. I always remind folks, stocks don't love you back. They don't even know that you own them. So not having that anchor and being willing to evaluate what's important to you and appropriate for you will very much serve you.
Oh, so well said. Thank you for that. So what would you say then is the best way to tackle biases, the best way for us to go about doing that?
Well, we have to kind of chip away at each of them individually, but one exercise that is often used is broad enough and easy enough is to think about a strategy and then imagine that it succeeds. And just think out 5, 10, 20 years down the line, and you imagine that success, and then think about what had to happen to achieve that success. And then do the opposite. Think about that strategy and think, oh, it failed, and what were the things that led to that failure? And this gives you a chance to broaden the vision and to see the potential risk and potential upsides, and kind of get rid of maybe some excessive optimism or pessimism that you might be feeling right now. Just broaden your view.
You always give such great examples, and I just appreciate that because you give us so much to think about and so much action that we can take, which is so important.
Thank you. Well, I've been very lucky that I've served in my business and had wonderful clients who have taught me everything I know over a lot of years. So I'm delighted to share.
Well, thank you, Catherine. It's always good to see you.
Great seeing you.
By the way, you can learn more about Catherine Scrivano by going to our website, thewomenseye.com. And I also want to let you know, exciting stuff here. The Women's Eye has a few books. The first is called 20 Women Changemakers. You can find it at changemakersbook.com. And our newest book is now available. It's called 20 Women Storytellers. You can learn more about that at womenstorytellersbook.com. And you can also find them, of course, wherever you buy books. So that's going to do it for this episode of the Women's Eye podcast. I thank you so much for joining me and Catherine Scrivano. Until next time, remember, it's the world as we see it.